Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. There's a good chance you'll be watching this video around the weekend of the Berkshire Hathaway annual meeting. I'm Jason Hall. This is The Smattering. I've got my friend Tyler Crow on here with me, and we're doing a number of videos this week talking about Warren Buffett, talking about investing. On this particular video today, I want to talk about a well-publicized mistake that Warren Buffett made and an unappreciated great decision that he made that more than made up for it. Hey, Tyler.
I really like this premise, Jason, but we're going to make it even a little bit harder with ourselves because I feel like the bailout answer for all of this is he bought Apple. But we're like, everyone knows he bought Apple. So let's look at the rest of the portfolio and see what were some other really great moves that he made to make up for some bad moves.
Exactly. So in parentheses, it wasn't Apple, right?
It wasn't Apple.
So let's start with this. And this has been, it's been a few years ago, I guess about a decade ago since it first happened, but this was a well-publicized decision that Buffett made that turned out to be a bad investment. And that was buying IBM. At the time, the thesis roughly, Tyler, and you can kind of weigh in a little bit here too, was IBM was still going to be a really important company in technology. Companies are still going to be depending on its hardware and its infrastructure. And it was trading for a good valuation. So in a way, Buffett went a little bit back to his old cigar butt ways of focusing on trying to find deep value and bought a company that, frankly, at the worst time to be getting into hardware for infrastructure, when exactly at the time that was the advent of the cloud and cloud services, right?
It's the old Buffett playbook of, look, yeah, it's not great, but it's going to throw off some cash. But it's a dwindling hardware business, but it's still necessary. And I can just basically harvest off of this for a long time, probably longer than the market is giving him credit for.
And needless to say, it didn't work out for a few reasons. IBM had started a services business, right, that it was really focusing on growing, made some acquisitions. I believe it had acquired Red Hat. And eventually, fast forward, and it did get to a point where the growth of that services business, it got larger than its hardware business, but it never really offset it. Buffett ended up walking away, booked a loss on the deal. IBM today is split up, right? It's not even the same company anymore. It's separate companies.
How long do you think Charlie Munger just nudged him with an elbow and said, "Hey, are we still doing this?
My guess is that Charlie used his famous line and probably looked at Warren and said, "Warren, you're smart and I'm right." And eventually
Probably.
Warren realized Charlie was right. So here's the thing. That was well publicized, right? And it's really easy to look at any investor's track record and find a mistake. You know, it is. But I think there's an important lesson, Tyler, and that is, you and I talked about this before we hit the record button, and that's, as investors, it's really easy to fixate on those mistakes sometimes, almost to our detriment, and forget about focusing on managing your portfolio holistically and focusing on making better decisions. And remember that all it takes is a couple of small investments that turn into big winners that are going to more than make up for, say, an IBM.
There is this weird instinct that we always seem to have of we need to make up for our losses in the place that we got those losses. You know, you dollar cost average down low enough. When this thing does bounce back, you're in a much lower position. You're going to maybe get back to break even before you sell, but there's no reason you have to do that.
Right.
And that's a pretty common fallacy I think a lot of people have is you don't need to make it harder on yourself and make the money back the way you lost it.
Willingness to walk away from a bad investment and instead of doubling down on those mistakes. That's one of Warren Buffett's superpowers, I think. Let's talk about one of those big winners that is I think underappreciated by investors. I want to talk a little bit about Moody's.
You're really barking up my tree here, talking Moody's. Like I said, we could have gone with Apple, but how about a rating agency where it's basically a de facto, it's not a duopoly.
It's
three?
Really a duopoly with a very distant third with
Yeah.
Fitch. You've got S&P and Moody's, which are these two big debt ratings agencies with their credit ratings that are so important, not just for companies that are going out looking to issue debt, but even governments, right? They rate everybody's debt, but re-rating that debt for the secondary market as well, too, right? Ongoing rating of companies' financial viability. And here's what I want to talk about and why it's so relevant to this is that for Berkshire, in terms of where the Moody's investment ranks, it's so easy to miss it in that Berkshire portfolio because there's around 50 stocks and it's number 8 round figures. It's worth about $7 billion. When you think about that $300 billion portfolio, Tyler, it's not much. But here's the thing that's amazing to me. That $7 billion started out as a $248 million investment. It has been an enormous multi-bagger winner that more than makes up for the losses from IBM and then some.
Not in necessarily the places that people would expect them to come from. It doesn't have all those fancy labels of hyper growth or whatever, those multi-baggers that people want to claim debt rating agencies to be. And yet a company with a high return on capital over a really long time happens to do magical things for portfolios.
There's one other piece of this puzzle that I think really highlights the math and how attractive it is. Last quarter, you remember when the 13F came out for Berkshire, there was a lot of talk about coca-cola and that dividend and how big a portion of the cost basis it is for Berkshire Hathaway. And that's all attractive. And Coke's been a pretty good investment too. But this is another one of those that every 2.5 years, Moody's gets turned into a free investment because Berkshire captures its cost basis in dividends paid. It's another example of how diversification into a few big winners can generate enormous returns over 10, 20, 30, 40 years.
And allow you to forget about the ones that where you made a mistake.